Welcome back, everybody. It's good to have you to another real estate market update for the greater Milwaukee area, this time October 2025. The year is coming to its final home stretch, and we have a lot of interesting economic stuff to talk about that is impacting the real estate market both nationally and also locally here in the Milwaukee area, from the job market, from mortgage rates, what's going on in the stock market, in the financial markets. There's some contradicting signals, so let's try to make sense of it together. I have put the data together here for you, so in the next minutes we'll take a look. But as always, let's get started with the numbers for the Milwaukee metro area straight out of the MLS. Inventory is up again 17% over 2000. If you have been in the market as a buyer this year, this feels so different than what it used to feel like in spring when we were really at the bottom of the barrel. So more inventory, good news for buyers. But to keep things in perspective, I always have the historic numbers below here for you. So before COVID with 3,000, over 3,000, and 10 years ago we had almost 6,000 units on the market in September. So comparatively speaking, it's more, but still not quite that much. Sold volume is again very, very low, not a surprise, and we have seen this over the last few years. So we are in a real estate recession in a sense that the market has shrunk. There are fewer people buying, there are fewer people selling. So that is a recession when the economic activity is going down. That doesn't necessarily mean that prices are going down, but volume is way down. If the US economy would be down 25-30%, that would be a completely different scale, but that's what we are seeing here in the real estate market over the last few years. We've been consistently on a very low transaction volume. September was no exception. Velocity is slowing down a little bit. In spring, summer, we have been around 5 days on market. Now we're inching up. It looks like every month a day. So we're at 7 currently. Still quite a fast pace, but a little bit less than what we've seen in spring, summer. The big surprise are prices. $400,000 was the median sale price in September in the 4-county metro area here in Milwaukee. And I ran the numbers twice because I couldn't believe it. We're double digit up, plus 12.36%. If you think back last month, we were at 7.3, 7.4, I think. And in August, we were below 3, just 2.9%. So the monthly number is sometimes fluctuating. But when you look at the big picture here, 10 years ago, less than half of what we're paying today for a house. So what are some of the market trends? Year-to-date median sale price is up 7.34%. So we're far enough into the year that you can look at year-to-date numbers that averages out that these monthly crazy fluctuation. I would call this an outlier, the 12.3. So 7.3 is kind of a more realistic number when you think about the value of your home. Inventory is higher than it has been in any other month in 24 and 25 and 24 actually. Buyer activity has started to slow down, which is totally normal. We see this every year in fall. That is just a seasonal change that we're seeing, and that takes out the competitiveness of the market and brings it down just a little bit. Average days on market have increased to 27, so average is different than median, so that is impacted by that market segment that is not doing well in the market, and that is really inching up. We can see that clearly. More listings are selling after a price cut. So those are overconfident sellers or agents that have put out the listing way too high. The market is ignoring it, and then sometimes they're only moving after a price cut. And actually 357 listings have expired in September without a sale. So if you compare that to our total inventory or sold volume, that is actually a significant number. August through October are always the best months to buy. That has been true every year so far. And it's no different this year. It's just that sellers are currently very impatient because what we've seen over the last years, the neighbor is telling you, oh, we sold our house in 2 days. And now we're coming down of that crazy high velocity that we've seen in spring, summer, just a little bit. And sellers have that fresh in their mind. So if it doesn't sell in the first weekend, they're already starting to worry. And that is really where you want to have the confidence to see, okay, this is what's currently going on in the market. Are we benchmarking correctly? Are we there? Do we have reason to worry or do we not? So this is just what they are comparing with is the spring market, and things are just transitioning and moving a little bit slower here in the fall market, but that is seasonally absolutely normal. Just to give a little perspective, so we are still in a seller's market. This is calculated from the RPR, and you can see here where we are currently here in a seller's market. I put a marker here where we have been last month, so we're moving a little bit towards a more balanced market, but make no mistake, we are still deep in a seller's market, so advantage remains with the sellers, even though it has improved a little bit more to the buyer's favors. Let's take a closer look at inventory. So we are up at a 2-year high. The blue line here is total inventory. So this is the highest we have seen it in the last 2 years. The red line is new inventory coming on the market. And you can see here that in spring, we were burning through inventory faster than we could keep it on the market. So total inventory was below the listings coming in on that month. Now this has reversed. We are seeing more inventory. So that confirms what we've just been talking about. List prices have been declining. So agents are anticipating this. And you can see that's why on average list prices are coming down. The buyers are just not agreeing with it because this is sold prices and they're supposed to come down as well. And they are holding remarkably steady and flat here. And you can also see this here in the sale to list ratio. So this is a measure on how competitive the market is. I always have this metric because it's very insightful. This is basically telling you in the Milwaukee area, how much have people paid on average over or under list price. So if it's over 100%, that means people have on average paid over, and we are still at 100.9 in September. Seasonally, we're always going down in fall, so I can already tell the first 2 weeks in October, we are slowing down a little bit more. So we'll probably break this 100 line, or at least getting right at it here in the next weeks. And that's when buyers have a little bit more room to negotiate. But it's not only the sales market that is very competitive. I have here new data from the rental market. So when you look at the top 100 rental markets in the US, Milwaukee is currently ranked number 6. Most competitive markets in the US to rent. We have 11 renters for every property. We are very close to like Chicago, Miami, Manhattan here. We're basically playing in the same league. So 6 out of 100. And that is just pointing you to that housing shortage that we have in Milwaukee. We just don't have enough inventory. So it's not that everybody's trying to buy a house. It's also in the rental market. It's the same thing. We just don't have enough inventory. On that note, we are celebrating this year 500 closed homes. And so with that, we are doing a lot of volume. We are seeing a lot of issues. We're seeing what's happening. And we are, instead of just fixing issues that are coming up in a transaction, we are trying to anticipate things and getting ahead of it. Whatever comes up when you're buying or selling a home, we have probably seen it before. We are closing on average about 2 transactions every week. We have at the moment 7 transactions to close on the books for October. So this is why we're so involved in the market, why I know what's going on. It's from my own experience every day, and I'm blending that with the data. And what that means for you is that you have the confidence that that experience is here to work for you. And I think when you're buying or selling a home, it's the biggest financial transaction in your life. You want to do that with confidence. And I believe that moving, buying and or selling should always be something that's fun and exciting, and you don't want to stress and worry about it. So it helps to work with somebody who has a lot of experience. By the way, feel free to look up our reviews and hear it from our past clients. You can just Google it or look on Realtor or on Zillow. Back to mortgage rates. We had some great news there in September. Mortgage rates have come down. I put kind of a waterline here over the last 3 years so you can see how low we are currently. Very few weeks over the last 3 years we have seen mortgage rates that are so low. So I think this is also what's been helping with the price increases that we've seen in September, is that the slightly lower mortgage rates have helped. Why did mortgage rates come down? It was triggered by the job reports that came out on August 1st. So if you have been watching my channel, you already know that the Federal Reserve is not setting mortgage rates. They're just setting the funds rate. So everything in the financial markets is connected. But mortgage rates are not dictated by the Fed. They are driven by financial market movements. And the jobs reports on August 1st was clearly a signal that sent mortgage rates lower because the market was being worried. And The big question is, of course, where are mortgage rates going to go from here? Last year, when we dipped down, we didn't stay there very long. We quickly went up to 7% again. Mortgage rates are notoriously difficult to forecast. Not only the job market in the US plays into this, but also geopolitics, the oil price, and a lot of other factors. So this is why it's always hard to tell where they're going. The consensus of most of the big banks and experts at the moment is that they're trending somewhat sideways. So yeah, we'll see where things are going from here. A lot of people took this also an opportunity to refinance. So we've seen refinancing spike in September. And people always ask me, is it time to refinance? Should I? And the rule of thumb that I have here for you is that about a 1% lower mortgage rate is usually worth it to refinance. That's a simple break-even calculation. I have an example here for you on a $400,000 loan. If you can refinance from a 7.5% rate to a 6.5% rate, that gets you a savings of $317 a month. Of course, you have refinancing expenses. It costs money to refinance usually, and it also takes a little time on your behalf. So is it worth doing it? In this case, that would give you approximately a 15-month break even. If you get 100% of your return on your investment in 15 months, I would say that's a good deal. So that's why I'm saying 1%, even a little bit less sometimes, depending on the mortgage amount, is totally worth it. I'm always a big proponent of making financial decisions based on numbers and spreadsheets. If you have to, emotions and finances just don't mix well. So always look at the numbers, always look at the data, especially when it comes to big financial decisions. But of course, we are all not immune to what's going on around us, and it impacts our thinking. People are worried about an upcoming recession. Consumer sentiment, of course, impacts what's going on in the real estate market. A recent survey from Lending Tree is showing that 2 of 3 Americans are worried about a potentially upcoming recession, and 75% of Americans state that the world news and or current financial events are impacting their decision making. So we are doing enough business in the market that we can even tell the impact of a holiday. Labor Day weekend was a great example. We had such great weather here in Milwaukee that you could really feel people had other things on their mind than buying or selling real estate. So you can see these things impacting the market. And of course, the economy has a big part of it. This is why I like paying attention to what's going on in the economy and how this is impacting the real estate market. Very interesting news from the commodity markets. We have gold reach $4,000 for the first time in history. Gold is generally considered a safe haven in times of economic turmoil. So if people are worried about war or recession or whatever you have happening, then a lot of money is moving into gold, and that is driving up the gold price. So when you look on the internet, a lot of people are making the conclusion that they say, oh my God, it's the US dollar that's falling and it's weakening. And I would say that is not the case, and I support this argument with looking at the oil price, because the oil price measured in US dollars is very low. We are about to drop below $60 the way things are going. And even though there is a shift away from the US dollar in the petro markets, there is still 80% of all the volume of oil is traded still in US dollars. So this is not telling us that there is a weakness in the US dollar, because oil is arguably a lot more important for the economy on a day-to-day basis than gold prices are. So this is the counter argument. If you see on the internet that the US dollar is weakening so much, and you see it because of Bitcoin and because of gold, I would say oil is the counter argument to that, because we see oil prices going down. Maybe in the next few days we might see below 60. We will see. What's going on with the stock markets? So this is, I would say, a little bit concerning, because the price to earnings ratio is at a lofty 31. And I have here a chart that goes back over 100 years. So appreciate the scale of this. And when you look back the last few times we have hit price to earning ratios that were that high, we got here in 2000 .com crash, and we have the great financial crisis, the mortgage meltdown here in 2006, 2007, and then we get COVID here. So this is not a good signal. The Wall Street responded favorably to the Fed's rate cut last month. But the question is, can the optimism last? What's going to happen with future earnings on the bigger corporations? and that will probably define where we're going with the stock market. One thing that is notable is that we have seen the second quarter GDP numbers revised. 3.8% GDP growth for the US is a very, very healthy number, but the caveat is that 92% of that was actually driven by AI investments. So a lot of the growth that we're seeing currently in the economy is driven by these gigantic numbers that are poured into AI infrastructure. And so the question is, where would we be with our economy if it wouldn't be for those AI investments? The job market is holding up relatively stable. Last unemployment number we had for August is 4.3%, and anything below 5% is considered full employment. So that's good news from the job market, but you can see the trend. We are inching up here, still in the green territory, but it's going in the other direction. Because of the government shutdown, we have not had latest numbers from the government on unemployment, so I have to look at a few other things. And a really good metric here are the numbers from ADP. As you know, ADP is a big payroll provider, service provider to many companies. Maybe your pay stub has an ADP logo on the top, so they have a lot of data, and so it's worth paying attention to what they're reporting. And they say in September the economy has lost 32,000 jobs based on their internal data. The positive news is that pay was up 4.5% over last year. So that is definitely good news because it brings purchase power back to people. That again impacts the real estate market. But losing jobs is not a good thing for the economy. When you dive a little bit deeper, you can see it's mostly the small and medium-sized companies that have lost jobs. It's the large companies with over 500 employees that have increased their headcount that are hiring. So that is interesting. And when you look at it by sector, you can see which sectors have increased. And we have lost, for example, 2,000 in manufacturing, 5,000 in construction, 7,000 in trade, transport, utilities, etc. The biggest loser has been leisure and hospitality. So that is telling us Americans are cutting back on the fun stuff, on the discretionary stuff, and that is the biggest shrinking market in the job market that we have seen. What's going on with inflation? Consumer price index came in at 2.9%. That's still quite a bit over the 2% stated target from the Federal Reserve. So Jerome Powell has to walk that balance always between propping up the job market and keeping inflation under control. That's what's called the dual mandate. And inflation is slightly up. 2.9 is not a reason to panic in my book. I put a red line here at 3%. So you can see how we're comparing back for the last 10 years here. We've always managed to stay below, except this, of course. So the question will be, are we staying below, or are we seeing inflation tick above 3%? The markets seem currently not as concerned about inflation as they have been a few years ago. So we'll keep an eye on it and see how the next numbers coming out. The Fed is going to announce another rate decision pretty soon on October 29th. We're going to know. And it looks like that the probability is pretty high that we're going to see a rate cut to 4 or just below 4%. And to put this in perspective a little bit, that would bring us down to, where's 4%? About here. To put this a little bit in perspective, you have here the Fed rate over the last, 20 years. And we would be somewhere in here. So you can see when inflation hit in 2022, we have really increased it as fast as we have never increased rates before. And now we're coming down, but we're still, even if we get to below 4, we are still going to be quite a bit higher as what we have been the majority of the last 20 years. So there is room for the Fed to cut down if they really have to. At the moment, where the markets are expecting a rate cut on October 29th. So in a few weeks, we will know. In terms of the real estate markets, they have started to flatten out over the last 3 years. This is a national statistic for all of the US. List prices have already flattened. And we're seeing different markets behaving a little bit differently. The Midwest and the Northeast have been doing a lot better than the Sun Belt or the southern states. But list prices at least have been stagnating. And with income going up every year a little bit, buyers are slowly but surely regaining a little bit of more purchase power, which is helping over time with affordability. Speaking of which, Zillow has just announced another update to their 12-month home price forecast. It's interesting to look back because in spring there really caused a little bit of a panic in real estate circles when they're entering the year pretty optimistically with plus 2.6%, and in April all of a sudden they were announcing that they're expecting real estate prices to go down minus 1.7%. I mean, it's not huge, but still it was the first negative number we have seen in many, many years from Zillow, so that raised a lot of eyebrows, but they are slowly backpedaling now, August and September here with 1.2%. As you can see, the Sun Belt is still, the southern markets and the western markets are still expected to be the most negative when it comes to home prices, and the Midwest and the Northeast still relatively strong. They're calling out Milwaukee with 1.2%. I beg to differ. I think we are on a good track to outperform what they are telling us here. But 12 months is always very difficult to forecast. I've gotten pretty good in anticipating what's going to happen in the next few weeks. That I feel confident telling you about, but 12 months is really hard to forecast. So based on everything that we've discussed about the economy, this is what I'm expecting for the next few weeks here in the Milwaukee market. First of all, the government shutdown has had very little impact so far on the real estate market. Of course, we're only on day 9, I think. So we're early on, so the longer this drags on, the more the implications are going to be. Hopefully, we will figure out the solution to that pretty soon. But so far, minimum impact on real estate. Supply-wise, I think we're still going to see a little bit more inventory. We have 2 listings coming up this weekend, and when I talk to my stagers and photographers, they are still pretty busy, which is telling me that other agents in the Milwaukee area are also working on listings that are still in the pipeline coming on the market before we are going to see the typical seasonal slowdown in November towards Thanksgiving and the holiday season. That's when things start slowing down there. Mortgage rates, I think, are going to remain for the moment in the low to mid 6s. But the real estate market in general is getting off its sugar high. So spring and summer have felt a lot different than they are right now. Things are normalizing, things are settling down. So we're getting off that absolutely crazy, insane pace that we've seen in the spring market. And that's why it's just a better time right now if you are on the buying side. Sellers have to play their cards right. We are still seeing listings go with multiple offers. If you're positioned correctly on the price, if you're not overpriced, if you're marketed well, then it is still possible to get multiple offers and end up with over list price. But going over that 100% sale to list ratio is getting on average more and more unlikely as we are moving more towards the holiday season. And sellers are generally impatient because they have heard from their neighbor who sold their house this year in spring in 2 days with 5 offers. So they're thinking they will have the same experience right now. And as a buyer, you can use that to your advantage because if the first weekend has come and gone and nothing has happened, then your odds of negotiating a deal are actually increasing quite a bit, and you can use that to your advantage. Seasonal fall is always the best time to buy. This is not only this year. This doesn't have anything to do with what's going on with the economy. Milwaukee has a very strong seasonal pattern. We see this every year, the difference between spring, summer, and winter, and we are right now in a very typical fall market the way we see it every year. Ironically, a lot of the buyers that I'm talking to at the moment who reach out to me are thinking about next year. A very common scenario that I hear is from first-time home buyers. They're telling me, yeah, our lease is up next year in March or in April or in May. So, that's around the time when we want to buy a home. We want to be ready for that. And I think it's great that you're planning ahead. If you are trying to take advantage of the market, then fall is just a better time than the spring market. And if you're thinking about buying a home, then a really good starting point would be our Milwaukee Home Buyer's Guide. It's about 30 pages. It explains the entire process from start to finish, how to prepare, so you know exactly what's ahead of you. I put a lot of tips and tricks in there that are specific for the Milwaukee market, mistakes to avoid, etc. So it's a really good starting point if you want to start reading up on it, and you can download it obviously for free on our website onpointrg.com. And if you want to have a conversation with me about your personal circumstances, the best strategy for you and for your family, feel free to reach out to me. I would be happy to have that conversation. Most people reach out to me with an email at m.auerbach@kw.com. but you can certainly also text me or give me a call. You have my cell phone number here on the screen. Just don't be surprised if I actually pick up, because that's what I do. And that's all I had for you this week. Thank you very much for watching. I'll see you at the next one.